Hello, this is Odisal Associates, Accounting and Finance Tutors. Again, I'm going to bring to you another concept of business combination. I'm not going to treat business combination in full now. At a later time, I'll treat business combination in full. However, there are some concepts that I feel I should explain before I start teaching business combination. The concept I'm going to talk about now is acquisition related costs. Acquisition related costs refer to the expenses incurred by an acquirer in connection with a business combination, such as merger or acquisition. These costs are typically incurred to facilitate the acquisition process and may include fees paid to advisors, lawyers, accountants, and other professionals. These are types of acquisition related costs: finder's fees, advisory fees, legal fees, accounting fees, other costs, e.g., travel, due diligence. Finder's fees are fees paid to people who locate or make it possible for the acquirer to locate the business that he wants to acquire. They are like agents that links the acquirer with the acquiree. They charge fee. This fee, when it is charged, is not part of the consideration for acquiring that business. Even though it was used, even though it facilitated the acquisition of that business, it's not part of the consideration. Advisory fees, these are professional fees that a professional will advise the acquirer about the business that the acquirer wants to acquire, whether he should acquire or whether he should not acquire. Fees are also charged. These fees, even though they assisted in helping to acquire that business, is not part of the consideration. Legal fees. Of course, you know that when businesses are acquired, agreements are written. And if you are a seriously minded person, you will definitely look for a lawyer that will write agreement for you, because this might be contested in court of competent jurisdiction, so that you know the right terms to put. And the lawyers will charge their fees. These fees are not also part of the consideration for the acquisition of the business. Then we have the accounting fees. Of course, you know the accountant will have to compute ratios and all the rest to tell you about the viability of the business that you want to buy, whether you should acquire or not acquire. And other costs, cost of traveling, cost of doing due diligence, and other administrative expenses. These are called acquisition related costs. Accounting treatment of acquisition related costs. Acquisition related costs are typically expensed in the period incurred. When we say an item is expensed, it means that it will appear in the statement of profits or loss and other comprehensive income. This is because they are considered to be costs of the acquisition process rather than part of the cost of the acquired assets or business. These acquisition related costs are just costs expensed or incurred in the process of acquiring that business. It's not part of the cost of acquiring that asset. Expense recognition. Acquisition-related costs are recognized as expenses in the income statement in the period in which they are incurred. This is in accordance with the matching principle, which requires that expense be matched with the revenues they help to generate. Impact of acquisition-related costs on financial statements. In income statement, it is expensed, recognized in profit or loss statement. In statement of financial position, it's recognized as assets if capitalized. Now, you might want to ask that we said that acquisition-related costs are not part of the cost of acquiring the asset. Why do we want to capitalize this cost again? In some situation, you could buy a business or acquire a company and you acquire that company, but there are some things that you need to put in order, which is not part of the agreement between you and the acquiree. But you said before you start using it, you must put this and this asset in order. So you are upgrading the asset. At that point, it's not going to be part of the cost that you used to buy the asset, but an upgrade of that asset that you have bought. Even though you are going to recognize it in your uh, asset account, you are not going to recognize it as part of the uh, consideration that was furnished to acquire that asset. In cash flow statement, it is recorded as cash outflow. So these are the basic three ways that we treat acquisition-related costs. Disclosure requirements. Companies are required to disclose acquisition-related costs in their financial statements, including the amount of costs incurred and the line item in which they are recognized. So these are the highlights I want to give concerning acquisition-related costs. Next, we are going to look at how this can be treated in your statement, financial statements. So I'm going to read out a question for you, and then we'll do the solving together. Example 1. Company A acquires Company B net assets worth 800 million for 1 billion. In connection with the acquisition, Company A incurs the following costs: advisory fees, 50 million, legal fees, 20 million, accounting fees, 15 million, due diligence costs, 10 million, travel and other expenses, 5 million. This will give total acquisition-related costs of 100 million. So we'll look at the accounting treatment of this. We have 100 million as the acquisition-related costs. This acquisition-related cost is not going to be part of the consideration that was offered or furnished by the acquirer. We've seen that the acquirer bought that business for 1 billion. In order to compute the goodwill for that business, we'll just say purchase consideration. $1 billion. Net asset acquired, 800 million. Goodwill, 200 million. As you can see in the computation, the 100 million that was spent on these various acquisition-related costs are not used to compute the goodwill. Sometimes students might make the mistake of adding that 100 million as part of the purchase consideration. In such a situation, the goodwill would now become 300 million, which is absolutely wrong. I've come across situations where this have been done, and of course, there is nothing you can do that to fail the student because he did not get the correct purchase consideration. So it's important that we know. Now, what happens? This purchase consideration, like we said, this acquisition-related cost that we said will be expensed in the company statement of profit or loss. So, since those costs were incurred and paid for, it will be that we are going to debit acquisition related cost, 100 million, and then we credit cash, 100 million. This is to record acquisition related costs. This acquisition related cost of 100 million will be presented in a separate line item in the income statement. Disclosure. Company A will disclose the acquisition related costs in the notes to financial statements, including the amount of costs incurred and the line item in which they are recognized. For example, acquisition-related costs of 1 billion naira were incurred in connection with the acquisition of Company B. These costs are included in operating expenses in the income statement. In conclusion, we can see that acquisition-related costs are typically expensed in the period in which they occurred because they are seen as expenses for that period in order to adhere to the rule of matching concepts. It's not going to be used as consideration of the asset that was acquired, but will be written off in the company's profit or loss account. I hope that students will learn not to join issues concerning acquisition-related costs by recognizing them in the statement of profit or loss and not mixing them up as part of the consideration. Thank you very much. I hope we learned something, and more will come on business combination before we do the main business combination. I hope you will continue to follow us so that you learn more concerning accounting. Thank you.